Well, hello there. That battery can last up to 24 hours even with the always-on display turned on. It's pretty cool.
All right, you've seen the headlines. You've felt it in your gut when you look at the charts, the talking heads on TV. They're all using these soft, fuzzy words, nervousness. Like the entire global market is just some shy intern on their first day at the office. They want you to think it's just a little case of the jitters.
You know, they give it these neat, tidy little names. A pullback, a healthy correction. It's a story, right? A story designed to keep you calm, to keep you from looking too close at what's really happening on the screen. They're telling you, hey, don't worry, it's all business as usual. But we're not here for the usual story. We're here for the data.
So, here's the question. What if this so-called nervousness isn't random at all? What if it's actually a symptom of a deep, fundamental error in the code? A glitch in the matrix that, once you see it, you can never, ever unsee it. That is the rabbit hole we are diving down today. We're going to jack in, follow the data stream, and find out exactly where the code is broken.
Okay, quick reality check before we go any further. This is all educational banter. You got it? We're speculating, we're looking at patterns, we're connecting the dots. This is not financial advice. The market is a casino, plain and simple. And the house, well, the house has a funny way of changing the rules when it feels like it. So, always bet responsibly.
So what is the official story? You know, the one being broadcast from those giant glass towers? Well, it's a symphony of big, boring, distracting numbers. They want you totally focused on the macro weather report so you don't notice the massive cracks that are forming right under your feet. First, they hit you with a number like this, $3.4 trillion. That's the potential extra baggage on the U.S. budget deficit, according to the big brains at Goldman Sachs. It's a number so huge, it's literally designed to numb your brain. It makes you go, whoa, okay, I guess the adults are handling some really complicated stuff up there. Then they pivot. They start talking about tariffs, an 18% effective tariff rate. See how precise that sounds? How calculated. They'll drone on about supply chains and geopolitical dynamics. It's all part of this complex, dry narrative that's meant to sound super sophisticated and, more importantly, totally under control.
And of course, the grand finale, AI, artificial intelligence. They love this one. They'll tell you that data centers are going to need over 175% more power by 2030. AI is the magic wand. It's the ultimate excuse for any insane valuation, any weird market move. It's the future, they say. Pay no attention to the chaos in the present.
But some of us, we remember the last time the machine really started to stutter. January 2021, GameStop. That wasn't just some meme stock rally. No, that was the first time a whole bunch of us saw a fatal flaw in the system's code, all at once. When that price surged, when the shorts started bleeding billions, and when they infamously turned off the buy button, yeah, that was the red pill moment for an entire generation.
Now this is where it gets really interesting. Look at the two theses. The suits, they saw a dying video game store. Their logic was simple, based on old-world fundamentals. But the apes saw the data. They saw a mathematical impossibility. The short interest was over 100%, meaning there were more bets against the company than there were shares in existence. It was never about the store, it was always about the glitch.
So for any new apes in the troop, let's break down what a short squeeze really is. Listen up. It's actually pretty simple. Imagine a suit bets your banana tree is going to fail, so he borrows your bananas, sells them immediately, and plans to buy them back later for cheap to return to you. But then, what if 1,000 apes show up and they all decide they absolutely love bananas and they want to buy every single one, right now? Well, the price of bananas goes to the moon, and that suit, he's totally screwed. He's forced to buy back those bananas at any price to give them back to you. That's the squeeze. Now you might be thinking, okay, but GameStop was a fluke. A one-time thing. But the data stream is telling us something else. The academics, they actually started digging, and what they found is that the glitch is repeatable. This paper here looked at the Silicon Valley Bank collapse and found a brand new catalyst for financial disaster. Yep, social media. And this chart just lays it out perfectly. It's crystal clear. The researchers found that during the SVB crisis, the banks that were getting a ton of negative attention on Twitter, their stocks fell 6.6 percentage points worse than the others. That's hard data. It's quantifiable proof that a digital rumor mill can become a real-world, full-blown bank run. The meme is now a weapon.
This image from the paper shows you exactly how they tracked it. They were able to measure a bank's pre-exposure to Twitter, so how much chatter was happening before the bank run even kicked off. This means it's not just about people reacting to news anymore. It's proof that just having a big social media footprint can be a massive liability waiting to blow up. The network itself is the risk.
And that brings us all the way back to the original glitch. The folks over on Superstunk realized this was never just about making a quick buck on one stock. No, they saw that the same viral wildfire that could trigger a bank run could trigger something way, way more dangerous with a heavily shorted stock. It's about a vulnerability so deep it threatens the entire system. Selling phantom shares, basically selling bananas that don't even exist, creates the risk of a system-wide catastrophic collapse.
So what do you do? How do you fix a system that's this broken? Well, the apes came up with a plan. DRS, the Direct Registration System. Look, think of it this way. Instead of letting the big communal storage hut hold your bananas and lend them out to any suit that asks, you take your bananas home. You put them in your own hut, in your own name. Now they are out of the casino. They can't play their games with bananas they can't get their hands on.
But here's the thing. The establishment isn't stupid. They see the glitch, and man, are they trying to patch it. How? By fighting our code with their code. This is straight from Goldman's own playbook. They're going quantitative, using data-driven, systematic strategies, building these giant portfolios with thousands of tiny little positions. You see what they're doing? It's a new defense. They've figured out it's a lot harder for a swarm of apes to target and squeeze 1,000 tiny positions than one big one. They're trying to make the matrix too complex for any one of us to read. We're watching this chart like a hawk. While you wait for the next candle, grab your free gear. Sign up for Public to get $20 in free assets. Check Webull for that BTC promo, or grab your NVDA stock on Moomoo. Links are in the description. Smash the like, subscribe to the tribe, apes together strong.
But here's the one thing their algorithms will never understand. This isn't just about numbers anymore. Like this post from Superstonk says, it's become a game that's literally testing the boundaries of reality. It's a movement united not by greed, but by a fervor for fairness. You can't write code for that. You can't quantify integrity inside some black box trading algorithm. That is the ape's edge. Our irrational, our unpredictable, and our unbreakable unity.
So, the suits are busy upgrading their systems. They're writing new code, building a new, more complex matrix to hide in. And that leaves us with only one question that really matters. Are you watching closely enough to find the next glitch? Let me know what you think down in the comments.